Usually when we think about giving a gift, there's this expectation of just simple generosity. You wrap a
Mm.
present, maybe you attach a nice card with a ribbon, you hand it over, and well, that's it. It feels clean.
Right. It's an emotional transaction. We like generosity to just be, generous, uncomplicated.
Yeah, exactly. But you step into the world of the Philippine tax code. And I mean, the BIR isn't looking at the wrapping paper or the nice card. They're looking at the wealth transfer hiding underneath it.
Oh, absolutely. Suddenly you're navigating this transaction landscape that is, honestly, it's a minefield of regulations.
It really is. Welcome, everyone, to a very special deep dive on ICPA Review Radio. If you're listening to this, you are likely a determined CPA board exam candidate, burning the midnight oil, just trying to master taxation.
And we know tax review can be incredibly stressful, right? There are days when the sheer volume of rules makes you want to throw your calculator right out the window.
But take a breath. We are here to coach you through it, step by step, all the way to a passing score. And today, we are focusing on a highly tested area, which is donor's tax.
Right. We're looking specifically at sections 98 through 104 of the tax code, as amended by the Train Law, Republic Act 10963.
And the reason we are targeting this today is actually pretty simple. This topic is a massive point generator for the CPA board exam.
It really is. The examiners, they absolutely love testing the exact thresholds, the sneaky exemptions, and especially those cross-border calculations found in these specific provisions.
Definitely. So the mission of this deep dive is to build an impenetrable conceptual foundation for you. We don't want you just memorizing flashcards.
No, you need to understand the why behind the law. That way you can, easily dodge those common multiple choice traps.
Okay, let's unpack this. Before we jump into complex exemptions and foreign tax credits, you need to know exactly what triggers the tax in the first place and, well, how much it costs.
Right. So under sections 98 and 99, donor's tax applies to transfers by gift for both residents and non-residents. And the scope of the law is incredibly broad here.
Like, how broad are we talking?
I mean, it applies whether the transfer is in trust or direct, whether the property is real or personal, tangible or intangible. If you are transferring property without adequate consideration, it falls into the net.
Wow. Okay, and what does it actually cost? Because under the train law amendments, the computation has thankfully been simplified, right?
Oh.
Compared to those old tiered brackets we used to have.
Oh, greatly simplified. The rate is now just a flat 6%. But that 6% is computed on total net gifts in excess of a 250,000 peso exempt gift made during a single calendar year.
Wait, I need a practical breakdown of that 250,000 peso threshold. Because let me give you the scenario.
Sure, let's hear it.
Let's say I'm feeling incredibly generous, right? I give a 300,000 peso cash gift to my sister on December 31st. How is that taxed?
Okay, so on December 31st, you subtract your 250,000 peso exemption from that 300,000 peso gift. You're left with 50,000 pesos in excess.
Right, the excess.
Exactly. You multiply that 50,000 by 6%, and that results in a 3,000 peso donor's tax.
Okay, simple enough. But then, the very next morning, January 1st, the new year, I give another 300,000 peso gift to my brother. Do I pay tax on the entire 300,000 because I, already used my exemption yesterday?
Nope. The calendar year resets.
Oh, wow. Really?
Yeah, on January 1st, you get a fresh 250,000 peso exemption. So you would again only pay the 6% on the 50,000 peso excess.
That is fascinating. The 250,000 peso exemption is basically an annual free pass that strictly resets at midnight on New Year's Eve.
That is exactly the mechanism. And here is a massive exam trap alert for you.
Yeah.
Always check the dates in computational problems.
Oh, because they'll try to trick you with the timeline.
Exactly. The examiners will list out 4 or 5 different gifts made throughout a timeline. All gifts made within the same calendar year must be aggregated to see if they pierce that 250,000 peso threshold.
Got it. So if the dates cross over into a new year, the bucket empties and you start your aggregation all over again.
You nailed it.
Okay, and what about valuation? Like,
Okay.
if I give away a piece of land instead of cash, how do we determine what that 6% is actually applied to?
Well, Section 102 dictates that valuation is based on the fair market value, or FMV, at the time of the gift.
Right, at the exact time of the donation.
Yeah, and for real property specifically, the rules of Section 88B apply. This means you have to use the higher of 2 numbers.
Like, what are the 2 numbers?
The zonal value determined by the Commissioner of Internal Revenue, or the fair market value shown in the schedule of values of the provincial and city assessors.
So always look for the higher of the two in the word problem. Okay, one quick side note before we move on. With elections always a hot topic in the Philippines, what if my gift was like a campaign donation to a politician?
Good question.
Does that eat up my 250,000 peso threshold?
Section 99 explicitly carves that out. Any contribution in cash or in kind to any candidate or political party for campaign purposes is governed entirely by the election code.
Assuming it's properly reported, right?
Yes, assuming it is duly reported to the Commission on Elections. So on the exam, if the problem explicitly states it's a duly recorded campaign contribution, your donor's tax liability is zero. It doesn't even touch your annual exemption limit.
Okay, that distinction brings us to our next major hurdle. We know how standard obvious gifts work. But the examiner is going to try to trick you with transactions that just don't look like gifts at first glance.
Oh, absolutely.
And this brings us to Section 100, the sneaky deemed gifts.
Yeah. Understanding the mechanics of Section 100 is crucial for the board exams. It deals with transfers for insufficient consideration.
What does that actually mean in plain English?
The rule states that when property, other than real property classified as a capital asset under Section 24D, is transferred for less than adequate and full consideration in money or money's worth, the difference between the fair market value and the actual consideration paid is deemed a gift.
Okay, let me test this with some numbers to make sure I'm getting it.
Yeah.
If I have a vintage car with a fair market value of 1 million pesos, and I decide to sell it to my best buddy for only 200,000 pesos.
Yeah, at a massive discount.
Yeah. The BIR is going to look at that transaction. They take the 1 million peso value, subtract the 200,000 peso payment, and that remaining 800,000 peso discount is treated as a gift.
Exactly. The BIR sees right through the facade of that sale. It's a wealth transfer disguised as a transaction.
So you'll pay the 6% donor's tax on that 800,000, assuming you've already maxed out your annual exemption.
You got it.
But wait, let me push back on this a little bit. What if I'm not selling to my buddy? What if my business is failing? The economy took a massive downturn, and I am just desperate for cash flow. I have a warehouse full of inventory worth 1 million pesos, but to keep the lights on, I have to liquidate it at a massive loss.
It's a distress sale, basically.
Yeah, I sell it to random customers for 400,000 pesos just to get the cash immediately. Is the BIR going to tax me on a 600,000 peso gift to random strangers?
That is the exact scenario the examiners use to test your deeper understanding of Section 100. And the answer is no, you will not be taxed for a gift in that scenario.
Wait, why not? The math is exactly the same as the car. The fair market value vastly exceeds the consideration paid.
Because the law provides a safe harbor called the ordinary course of business exception.
Okay, how does that work?
For a transaction to escape the deemed gift rule, it doesn't just rely on math. It has to pass a qualitative three-pronged test.
Right.
First, is it a bona fide transaction? Second, is it made at arm's length? And third, is it free from any donative intent?
Donated intent, the actual desire to give a gift.
Precisely. When you are liquidating inventory to strangers to save your business, you aren't trying to enrich those strangers. You are trying to survive economically.
That makes total sense.
It's an arm's-length, bona fide business deal born out of necessity, completely devoid of generosity.
So for your exam focus, listen up. If a multiple choice scenario goes out of its way to emphasize a bad business deal, maybe a distress sale, made at arm's length without any donative intent, the answer for the deemed gift is 0.
Exactly. Don't fall for the math trap if the qualitative conditions of a legitimate business transaction are met.
Here's where it gets really interesting. Now that we've defined what a gift is and what a disguised gift is, we have to look at where the property is and who is giving it.
Yes, because under Section 104, the rules change drastically based on residency and citizenship.
Right, so we need to talk about situs.
Situs, which is essentially the legal location or jurisdiction where an asset is recognized for tax purposes. It's a cornerstone concept for the board exams.
And what's the overarching rule there?
The overarching rule is this. Residents and citizens of the Philippines are taxed on their global gifts. That means properties wherever they are situated.
So if a Filipino citizen residing in Manila donates a condo located in Tokyo, that Tokyo condo is subject to Philippine donors tax.
Yes, it is fully taxable here.
But what about non-resident aliens, the NRAs?
Non-resident aliens are only taxed on properties with a situs inside the Philippines. Their tax base is strictly territorial.
Okay, real estate is easy to figure out. A building is either geographically in the Philippines or it isn't. But what about intangibles, like shares of stock or intellectual property?
That's where it gets tricky.
What counts as having a Philippine situs for an NRA's intangible property?
This is where you really need to memorize the specific statutory items listed in Section 104. The Code explicitly defines certain intangibles as having a Philippine situs because they derive their value from the Philippine economy.
Can you list them out?
First, franchises, which must be exercised in the Philippines. Second, shares, obligations, or bonds issued by corporations organized in the Philippines.
That makes sense. A Philippine domestic corporation's shares are Philippine situs. But what about foreign corporations? Can they be dragged into the Philippine tax net?
They actually can, under two specific conditions.
Okay, what are they?
If a foreign corporation has 85% of its business located in the Philippines, its shares are considered Philippine situs.
Wow, 85%.
Alternatively, if the shares or bonds of a foreign corporation have acquired a business situs in the Philippines, meaning they're actively used in a business here, they're also included.
Got it. Any others?
And finally, shares or rights in any partnership, business, or industry established in the Philippines.
Honestly, that's a dense list that can easily jumble in your brain during a 4-hour exam. Let's use a mnemonic aid to lock this in. When you see an NRA intangible property question, think of the memory trick 85 FSP.
85 FSP. Let's break that down for the listener.
Sure. 85 stands for the 85% foreign corporation rule. F stands for franchises exercised in the PH. S stands for shares and bonds of Philippine Core, or foreign core with a PH business situs. And P stands for partnerships, established in the PH, 85 FSP.
It's perfect. If it fits those criteria, the intangible is inside the Philippine tax net.
That mnemonic is a highly effective way to quickly filter through multiple choice options.
Yeah.
But there is a massive exam favorite that completely overrides that list, isn't there? The reciprocity rule.
Yes, the ultimate escape hatch for an NRA's intangibles.
Explain the why behind this rule for us.
What's fascinating here is how the reciprocity rule acts as an international tool. Even if an intangible asset meets the 85 FSP test and has a Philippine situs, the BIR will not collect the tax if the NRA's home country provides a reciprocal exemption.
And how does that function practically?
It functions in two ways. Either the NRA's home country simply does not impose a transfer tax on the intangible personal property of Philippine citizens not residing there, or the laws of the NRA's home country allow a similar specific exemption from transfer taxes for the intangible property of Philippine citizens.
So if the foreign country's tax code plays nice with our citizens' investments, our tax code will play nice with theirs.
Exactly. The BIR views this as a way to encourage foreign investment without double taxation. But remember, this reciprocity exemption only applies to intangible personal property.
Right. So if the NRA is donating land to Makati, there is no reciprocity rule that will save them. It is strictly for intangibles.
Spot on.
Okay, so the reciprocity rule can save all non-residents intangibles. But what if you're a resident or donating local real property? Are there other ways to legally escape the 6% net?
Let's look at Section 101, which covers outright exemptions and foreign tax credits. Let's start with the outright exemptions.
Mark, what's first?
Section 101 exempts gifts made to or for the use of the national government or any of its nonprofit agencies or any political subdivision. That's fairly straightforward.
Yeah, that makes sense.
But the second category is where the complexity lies. Gifts in favor of educational, charitable, religious, cultural, or social welfare NGOs and philanthropic organizations.
Donating to a charity. I mean, the government is willing to forego the 6% tax because the charity is doing good work for society.
That is the intention.
Yep.
But there is a statutory catch, and it is an exam trap alert of the highest order.
Uh-oh. What's the catch?
The exemption only applies provided that not more than 30% of said gifts shall be used by the donors for administration purposes.
The 30% rule. Let's explain why this exists. The government doesn't want to exempt a donation that is just going to pay for the charity's bloated executive salaries or, office renovation.
Exactly. The money actually needs to go to the charitable cause.
Yeah.
And examiners absolutely love hiding this detail in a long word problem.
Oh, I bet they do.
You'll be reading a thick paragraph about a generous donor giving millions to an accredited social welfare organization. And buried in, the fourth sentence, it will casually mention that the NGO uses 35% of its donations for admin salaries.
And the moment you read 35%, alarms should be blaring in your head. The exemption is disqualified. The entire gift becomes taxable. Just Lock the maximum 30% for administration rule into your brain.
Yes. Now, this raises an important question for residents and citizens. Since the Philippines taxes them on their global gifts, what happens if they donate property located abroad and that foreign country taxes them on it?
Aren't they getting double taxed?
Exactly.
This is where foreign tax credits come into play to save the day, also found in Section 101. If a citizen or resident pays donor's tax to a foreign country, they get a tax credit against their Philippine donor's tax.
But it's not a simple one-to-one deduction, is it? We don't just subtract what we paid abroad from our Philippine tax bill.
No, it requires a step-by-step mathematical reasoning process because there are strict limitations.
Right. The Philippines will allow a credit to relieve double taxation, but they will not allow a credit that is higher than the Philippine tax generated by that specific foreign property.
So you have to compute a per-country limit, and if you donate it in multiple countries, a global limit. Let's walk the listener through a real scenario to lock down these fractions.
Let's do.
Let's say I am a resident citizen. I donate a condo in Tokyo worth 5 million pesos, and I pay a donor's tax in Japan of 400,000 pesos.
Okay.
And then in the same calendar year, I also donate a piece of land in Manila worth 5 million pesos.
All right, let's break this down. Your total global net gifts are 10 million pesos. 5 million in Japan, 5 million in Manila.
So first, I calculate my Philippine donor's tax on the entire 10 million, right?
Correct. You subtract your 250,000 peso exemption from the 10 million, leaving 9,750,000 pesos.
Okay, I'm following.
Multiply that by the flat 6%, and your total Philippine donor's tax is 585,000 pesos.
Okay, so my Philippine tax is 585,000, but I already paid 400,000 to Japan. Can I just deduct the whole 400,000?
No, and this is where we calculate the per-country limit. You take the net gifts made in that specific foreign country, which is the 5 million peso Tokyo condo.
Right.
You divide it by the entire global net gifts, which is 10 million.
Okay, so 5 million divided by 10 million, that's a fraction of 1/2.
Exactly. You then multiply that 1/2 fraction by your Philippine donor's tax of 585,000 pesos.
Okay, let me do the math. Half of 585,000 is 292,500 pesos.
That 292,500 is your per-country limit.
Ah, I see. So even though I paid 400,000 pesos to Japan, the Philippine government is capping my credit at 292,500 pesos.
Yes. The allowed credit is always the lower of the actual foreign tax paid, or the computed limit. Since the limit of 292,500 is lower than the 400,000 you actually paid, you can only claim 292,500 as a tax credit.
The rationale here is crucial, isn't it?
Yeah.
The limits ensure the Philippine government isn't inadvertently subsidizing the higher tax rates of foreign jurisdictions.
Exactly. That's the policy behind the math.
And what if I had donated in Japan and the UK?
Then you would calculate a per-country limit for Japan, a per-country limit for the UK, add those allowed credits together, and then run a final global limit calculation.
Okay, and how does the global limit work?
For the global limit, you lump all foreign gifts into the numerator, divide by the entire net gifts, and multiply by the Philippine tax. You then compare the total allowed per-country credits against the global limit, and again, take the lower amount.
Wow, okay, so what does this all mean for actually dealing with the BIR? You've identified the gift, you valued it, checked the situs, applied the NGO exemptions, and computed the final tax using the foreign tax credits.
It's a lot of steps.
But computing the tax is only half the battle on exam day and in real life.
Yeah.
How do we actually comply with the law?
Compliance is heavily tested. Under Section 103, any individual who makes a taxable transfer must file a return under oath in duplicate.
And the timeline is incredibly strict, right?
Very strict. It must be filed within 30 days after the date the gift is made.
30 days, not the 15th of the following month, not quarterly. 30 days from the exact date of the gift.
And it is a pay-as-you-file system. The tax due must be paid at the very time the return is filed.
Where do you actually go to file this?
Generally, it's filed with an authorized agent bank, the revenue district officer, the revenue collection officer, or the duly authorized treasurer of the city or municipality where the donor was domiciled at the time of the transfer.
But what if the donor is a non-resident? They aren't domiciled in a Philippine municipality.
Good catch. For non-residents, the return to be filed with the Philippine embassy or consulate in the country where they are domiciled, or directly with the Office of the Commissioner of Internal Revenue here in the Philippines.
There is one last technical definition in Section 104 we need to briefly unpack before we wrap up, and that is the definition of a deficiency. In tax terms, What exactly does the BIR mean when they assess a deficiency?
Essentially, a deficiency is the mathematical difference when the true tax imposed by the law exceeds the amount shown as the tax by the donor on their original return.
But it's a dynamic equation, isn't it?
Yes. The amount on the return is first increased by any amounts previously assessed as a deficiency and decreased by any amounts previously abated, refunded, or repaid.
So it's basically the BIR's way of reconciling what you paid versus what you actually owed after adjusting for past errors and corrections.
That's the best way to think about it.
All right, we have covered a tremendous amount of ground today. Let's synthesize this into an exam day checklist. If you only remember 3 things as you walk into your testing center, make them these.
Okay, let's hear them.
Number 1, the 250,000 peso exemption is cumulative strictly per calendar year. It resets on January 1st, and any excess is taxed at a flat 6%.
Right. And number 2, transfers for less than adequate consideration are deemed gifts based on the math, unless they pass the qualitative test.
The safe harbor.
Exactly. If the scenario highlights a bona fide arm's-length transaction in the ordinary course of business without donative intent, like our desperate business liquidation, the tax is 0.
And number 3, for NGO exemptions, beware the administration trap. If the problem states that more than 30% of the gift is used for administrative purposes, the exemption is dead.
Keep that checklist handy. It will absolutely save you points on multiple choice questions designed specifically to trick you.
As you take your study breaks today, I want to leave you with a final thought to ponder. If we connect this to the bigger picture, we talked a lot about the reciprocity rule for intangible properties.
We did.
Consider how this rule actually functions as an international bargaining chip. Our tax code is essentially saying to other countries, we'll play nice with your citizens' investments, but only if you play nice with ours.
It's a great point.
How might that geopolitical reality influence where a wealthy non-resident alien decides to incorporate their next big business venture?
It's a reminder that tax law isn't just about accounting. It's about global economics and behavior modification.
Exactly. Tax is the language of policy. Next time you look at a problem, remember that you aren't just calculating numbers. You are unraveling the story behind that wealth transfer we talked about at the start.
Keep grinding, keep studying, and trust your preparation.
You've got this. Good luck on your upcoming CPA board exams.